Look at him punch.
Look at him punch.
Oh, got him. Red.
All right. You guys remember Rock'em Sock'em? I don't know if that was very relevant if you're under the age of probably 22. If you're older than me, you probably remember playing Rock'em Sock'em. If you're younger than me, I don't know if you do or not. Maybe. But let's get into the video. Today, I want to do a Rock'em Sock'em style video with Coke and Pepsi Stock, ticker KO and ticker PEP. If you're new here, I'm Cashflow Cart. I'm a 22-year-old dividend investor. I've been on this YouTube grind since late October or early November, so I'm relatively new at this. But if you're subscribed and you've been supporting me, thank you so much. So we're going to do 3 rounds today, and we're going to talk through some of the key differences with these two consumer staples giants. We're also going to touch on, what I'm doing. Look at that, though. Cherry Coke. Round 1, diversification. So when I think of diversification, I kind of think of it in 2 layers. I think of global diversification, and then I think of portfolio diversification. So starting with global diversification, I gave Coke and Pepsi both a check mark. They're pretty similar. We can see here for Coke, here is the net operating revenues, for Q3 of 2023. You can see they have, revenue coming from Europe, Middle East, Africa, Latin America, North America, Asia Pacific, global ventures, and then their bottling investments, corporate, and then eliminations, making up a total of $11.9 billion in revenues in Q3. We can do some quick math if you guys want. When I see something like this with a breakdown, I'll usually just try to look at, okay, what's the percentage of revenue coming from North America? Because, if you're American like me, you probably already have a bigger portion of your portfolio diversification coming from North America. So we'll go with, the North America revenue number for Q3. We'll divide that by the total number. Comes out to about 37% of operating revenues from North America. At only 37%. Coke, we gave a check. We have that global diversification that we were looking for. We'll try to do a similar thing with Pepsi. For Pepsi, it's a little more difficult because, on their investor relations site, they break it out into Frito-Lay North America, Quaker Foods North America, and then PepsiCo Beverages North America. And then they have, all of their brands lumped in for Latin America, Europe, Africa, Amnesia, and then APAC. Amnesia and APAC and LATAM. A lot of abbreviations here. We'll do the same kind of thing. What we're going to do here is same thing, Q3 2023. You can see here 12 weeks ended. We'll add up the revenues, generated from North America because it doesn't give us them broken out. 7161. And then we'll go ahead and divide by, again, that total number here. That's the total revenue, of all the divisions for Q3 2023. Okay, so we're comparing apples to apples here. 453 comes in at 59% of revenue for Pepsi is generated in North America. Coke, I think we said 37. So Coke, you have a little bit more of that global diversification, but you are getting global diversification, with both stocks. Let's move on. Now we'll look at portfolio diversification here. Okay, we just did global diversification, only focusing in on revenues, but there is other levels, I guess, or layers of diversification. And with Coke, you got to realize you're really only getting beverages. Okay, so there's sodas. They have some alcohol. They've got smart water. I didn't do like a whole, visit to their website for this, just because it is just the beverages. We see Fairlife, Minute Maid. I mean, they've got some huge names, but we have to give portfolio diversification to Pepsi. Okay. And the reason for that, we come over here to our products on the PepsiCo website. They have, way more segments. They have Doritos, they have other snacks. Pepsi is not solely a beverage company. Okay. So just briefly looking through these: cookies, Cracker Jacks, Captain Crunch. I mean, these are guys that, that aren't going anywhere. And they own so many of these brands. Funyuns, that's kind of a controversial one. I don't know. I don't know if you guys like Funyuns. I'm going to say no. Fritos are good. Lay's, Life Water, Sweet Tea. And then they've got some brands you might not recognize if, they aren't as prevalent, I guess, in your area, wherever you live. Pastaroni. I mean, they got everything. Pretzels, Rockstar Energy. Coke has Monster, though, and that's definitely bigger than Rockstar. I think Coke has Monster. Did I put that on here? Or Monster's a standalone. What am I talking about? Let's keep moving on. Popcorn. I like their popcorn. SodaStream. I think that one's seen its better days. And then you'll see Starbucks here. We've talked about this before. They do not own Starbucks. However, they own a license at Pepsi to, sell those already packaged Starbucks drinks, the double shot, triple shot, the glass bottles, that stuff you buy at a gas station, vending machine, whatever. So they are partnered with Starbucks in that sense. Tostitos, obviously a huge one. I just got some hint of lime chips, and I forgot how good those were. So we're going to give round one to Pepsi, I guess, just because of this portfolio diversification. But it's not over yet. Round two. If you guys watch my channel, you'll know I am a dividend growth investor. I do seek total return in my investments, but I do have a kind of a bias towards building a passive income stream and never selling my underlying stocks. Obviously that's in a perfect world. Round two, dividend metrics. Let's go. Okay, so we gave the starting yield to Coke, and we'll go through these. The 5-year CAGR, that's compound annual growth rate, specifically of that dividend. So on this channel, anytime I say, 5-year CAGR, 10-year CAGR, I'm referring to, okay, how have they grown the dividend? What's the compound annual growth rate of that? We gave those both to Pepsi. Free cash flow payout ratio. We've talked about this before, but how I like to think of free cash flow is essentially discretionary cash, okay? So, after Coke, after Pepsi, they've paid their operating expenses, they've paid for capital expenditures, and basically anything essential to keep the business going and running. That leftover money is their free cash flow. They can reinvest into the business. We see Pepsi making acquisitions of a lot of these brands. They can also pay out some of that free cash flow to shareholders. And that's why I like to use the free cash flow payout ratio as kind of my dividend sustainability metric. Don't know if I said it, but I also gave that one to Pepsi. But, let's double check. So I'm on Seeking Alpha. We'll come here to the dividend tab. First up for Coke, a starting dividend yield today. I'm recording this in early January of 3.08%. We go to Pepsi, same thing here, 2.93%. So we did give that check mark to Coke, but these are pretty close, and definitely Pepsi's yield could be increased and they could change places, but we also want to pay attention to kind of our yield on cost here down the line. So we'll look at the 5-year compound annual growth rate of the dividend. We gave that one to Pepsi. Coke's is 3.36%. That's a slower growing dividend, at least relative to a lot of the other dividend stocks I see people talk about. But, with that 61-year track record of dividend growth, they've obviously made this a firm commitment. I mean, in 61 years, you got to go through a lot of different business cycles. So I don't think this is going anywhere. But again, the trade-off is maybe a slower growth rate of the dividend moving forward. We'll look at Pepsi's 6.63%. Quite a bit higher than Coke's, and they also do boast that 51-year dividend growth streak. So we gave the 5-year to Pepsi. We'll look at the 10-year. Not to say that any of these trailing, growth rates necessarily can be translated to the future. And I'm going to get on a tangent here, but I do see a lot of, dividend YouTubers sometimes using some model and just kind of, projecting future dividend growth, using past numbers. I don't think it's really always fair because, as companies go through different stages, they slow down their dividend. A lot of different stuff happens, but we will look at it. 10-year for Pepsi, 8.24%. Okay, so you can already see Pepsi's slowed down the growth rate of their dividend just by comparing that 10-year number here to the 5-year number. You can kind of see what I was talking about there. Coke's 10-year number of that dividend growth, 5.09%. Same story here. They've slowed down. We did give that check mark to Pepsi in this round. We'll look at the free cash flow payout ratio, and I just touched on, why I like to use this one. Come over here to dividend safety. Again, this is for Coke. Cash flow payout ratio on a forward basis for Coke is 66.55%. I feel relatively confident in that number, and I do think this dividend is very safe. Another thing you can check here is, okay, let's compare it to Coke's 5-year average right here. And you'll find that on the exact same tab. So 66.55% now on a forward basis, whereas the 5-year average of that free cash flow payout ratio, 74.11%. Okay, so what story does that tell us? They haven't had to eat up a bigger chunk of their free cash flow, in recent times compared to their 5-year average. We like to see this number preferably in line with or lower than that 5-year average. Does that make sense? Let's peek at Pepsi. Dividend safety, 52.99%, slightly lower again than that 5-year average. We gave that check mark to Pepsi. Okay. So I guess for this round, in terms of starting yield, we would give it to Coke, but in terms of some other metrics I like to look at, we would give it to Pepsi. Not to say there's a right answer. Let's just move on to round 3. A few fundamentals. And I'll have other videos where I'm going to go over more in depth, all the actual just fundamentals I use. But today we're going to pick out, 3 of my favorites. And that's net income margin, net income growth trend. I like to identify that uptrend. It doesn't have to be perfect. I understand that. And then the trend of the free cash flow per share. I feel like a broken record always saying free cash flow, but let's look. So we'll look at Coke's first. I'm not going to spend, too terribly long on this, but we can see December 2018 compared to this TTM, which is basically, 2023. This data just hasn't updated yet. What do we see? 6.4, 10.7, and along the way, Coke is typically moving their net income in the right direction. It's an uptrend. That's a check. We'll look down at free cash flow per share. Reason why I like to use free cash flow per share, because that's going to be, free cash flow per share, share outstanding. And those are the shares that Coke is going to pay dividends on. Same thing here. We see that nice solid uptrend. Again, it's not perfect. We see December 2021 is the highest, but, they're moving the needle in the right direction. Do the same thing on Pepsi. Financials, cash flow, net income. It's not as pretty of a trend with Pepsi, okay? So we had to give that net income growth. We had to give it to Coke. We'll look at free cash flow per share as well. Here we are. I don't know. I don't think we can call this a trend. It seems relatively flat. However, they have been able to reward shareholders, and they do have a sustainable dividend. But in terms of the last 5 years, we can't really identify that trend in net income and free cash flow per share with Pepsi. We gave it to Coke. What else? Net income margin. And, earlier we talked about the portfolio diversification. Although Pepsi does have more diversification here, one of those trade-offs is Coke can zero in more on kind of their core, what they're good at, which is beverages, and they can really impress shareholders with their margins. So we did give that one to Coke. Again, we'll peek at it. Find that on profitability on Seeking Alpha, and net income margin, 23.92%. Again, I do like to compare stuff to the 5-year average. That's just kind of how I think. I kind of want to find companies I love and then find, opportunistic times to buy them within a 5-year window. And then we'll look at Pepsi's profitability, net income margin, 9.05, and it is a little lower than the 5-year average. So, we had to give round 3 to Coke. Okay, with all that being said, we got Muhammad Ali winning a boxing match, apparently. And what are my thoughts in this one? I know if you guys have been with me, you'll know I've started a small position in Coke. I'm certainly in no rush to build it out. I wouldn't say it's a screaming buy right now, but, I do like the prospect of how much of a sleep well at night stock it is for me. We'll have to see what 2024 brings in terms of the broader market and how that affects, these two consumer staples names. I'm going to continue building out my Coke position, kind of slowly but surely. Unless we see a bigger dip, then I might get more aggressive. I'm definitely not opposed, though, to down the line owning Pepsi. But, for me, it's Coke. I love the margin. I love the long track record of dividends, and I'm going to give this one to Coke. Let me know what you guys think down below, if you hold one or if you hold both, or, if you even think it's fair to compare these two. I don't know. Like I said, guys, Cash Flow Cart, thanks for joining me today. New videos on Monday and Thursday. I'm super excited to build wealth with you guys this year. So everyone have a great day.